Well, position management is the name of the game as we go into the Jackson Hole Symposium. It's a word that we rarely ever use, but it rolls out once a year. That word symposium has got a lot of traders agitated as to exactly what we're going to hear from the great man, Mr. Jerome Powell, the kind of guidance that we're going to have towards the Fed's reaction function. Hopefully, it will allow us price risk a little bit better around the September Fed meeting. Is it growth they're interested in, labor markets, or is it the other side of their mandate, which, of course, is the inflation side of things, which is pulling away from target and is causing a few on the Fed, a few angst. So that's something that we'll be watching very closely. We're looking at US dollar longs at the moment. They're still building. We're seeing shorts trim back a little bit. We're seeing core equity positions being trimmed back into Jackson Hole, and gold's trading a bit of a range at the moment. We also look at what's happening in the crypto scene. We ask where the risk is at the moment. But a lot's going on in financial markets, even though volatility is pretty low. We're going into Labor Day holiday, potentially set for increased volatility playing through. But we'll discuss all those factors. It's time to get in front of the screen. This is the trade-off. Hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we will navigate all the financial markets, the news, the moves, the shakers that's going on in this world, the technical setups, the price action, and try and make a rational decision as to where the market may want to go in the short term. Anyway, Blake, come into the program, my good sir. We've changed the date today. We're obviously doing this on the Friday. I've got my party shirt on. You're obviously looking good as ever. We're looking ahead to Jackson Hole. I'll probably be asleep at the time. I'll be managing my positions going into that situation. It's coming out midnight my time on Saturday or Friday night, whatever you want to call it. But you'll be wide awake, bushy-tailed, and looking for the weekend. But obviously a lot going on. We weren't hoping to see a bit more volatility in this market. But is this what you're talking with clients about at the moment?
Yes, it is. I think it's going to be the most explosive day of the year.
Woo,
I actually do think the risks are really tilted to higher volatility over the course of the next 24 hours. And yes, you're right. It's going to be early in the morning for me, late at night for you. But have you ever traded under the influence, Chris?
I have done. It's not really trading. It's more on the old punting, a bit of fun. But yeah, if you're doing something serious and following a rules-based program, it's definitely something you want to shy away from. And it's not something I'll be doing tonight for sure. But
I was going to say it's going to be pretty late at night, and I would assume on a Friday night, some of your traders listening in might be a little knackered by the time they get.
You're sitting down the pub on a Friday night, and you've got. You're watching the footy on the background. You've got your sports on, your horses on the side, and you reach for your phone, get your trading app out, put it away. It's got to keep the discipline. Anyway, I want to pick your point up about So we're going back on a more serious note, getting back to the point of this explosive move in volatility, because it's not something the market necessarily shares. Do we call this a grey swan? Something we know about that's necessarily underpriced? I want to explore that. Let's go into topical thunder. Well, I want to talk about this Jackson Hole situation because we all know he's coming. He's going to be speaking at 10 a.m. Eastern time, and it equates for us Aussies here. At midnight on Saturday, Friday night, whatever you want to call it. We know this is coming, and I think so much ink has now been spilt as to exactly what we're going to hear, what we're not going to hear, where he's going to guide us to. But I touch on this point of volatility because. If you look at the forward volatility markets, they're pricing about an 80 basis point move up or down in the S&P on the day. Now, that is under where where the market's expecting for next week's Nvidia earnings. And obviously, Nvidia an 8% weight on the market, and they're expected to move up or down 5.8%. So you can understand why the vol markets are priced for big moves there, but they're not. They're seeing this as a kind of in terms of that pricing, and FX vol is pretty low as well. They're seeing this more as a sort of a mini FMC more than something that's categoric, and we're going to be like, whoa, this is so definitive that we're going to, it's changed the game, that they're completely focused on right tail risks and inflation. And this idea that 70% rate cut price that's priced for September is completely misaligned. It should be close towards 40%, 50%. The dollar rallies. And the most important situation for me here is the slope of the yield curve. When everyone's been in these steepener trades, and that we get a bear flattening, so the front end moves up as rate cuts come down. I think that's a major risk, and that would be where the volatility comes. That's where the dollar rallies, equity comes under pressure, duration assets come down, gold comes down, crypto falls. So what are you looking for in Jackson Hole? I'm sort of more cognizant that we can explore it in the next section. But yeah, talk to me about this idea about volatility. What is the market underpricing? What are they not seeing?
Well, I think what the market's underpricing is that the Fed chair, I don't think, is going to elude or really open the door wide open for a September cut. And I think that's where the market is thinking right now. I mean, you could see pricing is in the 70%, 75% range. Am I correct around
Yeah,
that
70,
number?
71, something like that. Yeah. It's come down. I
Yeah.
mean,
And
last week there was about 110% chance we get, or a 10% chance we get 50 basis point cuts. So they have reduced that, but you're right, 70%. Yeah.
but if that comes down decisively after tomorrow, it's the kind of volatility. And I'm not saying volatility is going to spike necessarily. I think that you're going to get follow through in whatever move you see. So if especially if the Fed chair is a little bit more hawkish, he gives President Trump the middle finger, so to speak. I guess we could call it that. But he's basically says, hey, we're waiting for the jobs report. The inflation data is still pretty sticky. Our economy. You saw PMIs today; they were rock solid in the mid 50s. I mean, which is expansionary. Our economy is still running relatively hot, minus some cracks in the labor market. But I think the Fed really needs to see what before the Fed embarks on this. Like, hey, we're going to cut. The market's also looking at two, possibly three cuts for the remainder of the year. If the market has to say, wait a second, we might not even get a cut in September,
Mm.
and that pricing drops down to, let's say, 20 or 30% or maybe 40%, somewhere in that neighborhood, we could get an actual move on Friday that bleeds into Monday, Tuesday, especially if you're trading FX. And the dollar's been beat down so hard, it's near really critical levels of support. And I think that there's a risk that the euro, trades back below 116 and towards
There it is.
114 handle in the days ahead.
There it is. I mean, look, I personally sit in the same camp as you. I think, if someone said, "Yeah, Chris, put your family fortune," you have to put your family fortune on being long dollars or short dollars. Won't make the call. I'd be long dollars into the meeting for sure, because I think, like whilst the Powell make it out that they do have monetary tight financial conditions, and that if the data warrants it, and he's obviously referring to the next payrolls number on the 5th of September, and then the next CPI number, which comes out on the 11th or 12th of September. Those two are absolutely key on the September call. There's no doubt about that. If we get another weak payrolls number, there will be Fed members who have been focused on inflation who will be saying maybe we do need that insurance cut, because the labour market will be hard to turn. Given that the 3-month average at the moment in payrolls is 35,000, we've seen those massive revisions down consistently. And there will be some there. But also, look, next week we've got a core PCE number. And again, that's going to be really important. We know how to model that because we've had the CPI and PPI elements, but it's likely to come out at 2.9%, which is 90 basis points above the Fed's target. And that's been moving up progressively since April. And in any other market environment, the Fed would be hiking in that situation. So, I think he's going to say that we've got moderately tight financial conditions, which seem to be right now. We may have to take it down to neutral, but that's going to be the condition on the data. There's going to be other Fed members who are obviously calling for to be on hold for now. So I think the wash up from that, the risk is, and I would refrain from recommending anyone trades over this because there is a skew. I see a flatter yield curve driven by rate cuts coming down to 40-50%, which I think is probably fair at the moment. And the dollar rallies, gold comes under pressure, and I think that bear flattening of the yield curve would be a risk to equity markets there.
Chris, just to as we move into the next topic, which I think is an important one, and we're going to revisit this actually from last week about the economy. But I do want to let everybody know, like I'm going into the Jackson Hole speech, flat dollars. I have a couple crosses that I'm playing, but I do want to be able to react to the speech rather than put myself out there before I know decisively what's happening. But I want to talk.
So I think that's very, very prudent. White man
Yeah.
says that in these situations it can be better to prophesize than react, and I think that it could be better to react than prophesize. I think is the way. So wait for the market to tell you what they're thinking and manage that accordingly there.
Right. And this brings us to our next topic, which I want to talk a little bit about inflation versus growth, because we had this conversation briefly. We touched on it last week. I believe it was last week or last 2 weeks we talked about this. But we just got the FOMC minutes, and they read a little bit more hawkish. And we saw a lot of, the regional governors talking about inflation and how persistent it is. And like I said, it read relatively hawkishly, and the dollar got a lift from that yesterday. And this is where the rubber is going to meet the road, because we are going to be faced, I believe, I truly believe, and it's probably the intersection is upon us, where inflation is going to be sticky, yet you're going to have a labor market, we'll find out here in the next couple of weeks, in the beginning of September, first week of September, where I have a labor market that actually continues to look like it's cracking. As a Fed governor or Fed chair, what do you fight? I mean, the inflation, as you just pointed out, PCE is probably going to be close to 2.9%, well above the Fed's target. They should be raising rates in any other environment, and yet you got political pressures. You're going to have a Fed that's faced with: do we fight inflation, or do we do we help the economy and let inflation run hot? You in the past had said that you would think that the Fed would fight a slower economy and they'd just cut rates. But has your opinion changed since, over the last couple of weeks?
Well, I think the market as well has put so much weight on the growth side of the mandate rather than the inflation side of things, which is why we've had such aggressive rate cuts being priced in. Yeah, they've just been focused on the growth debate, and that's been steered to an extent by the fact that you've got the Wallers of this world, Bowman's, some of the other Fed members who have been saying, yeah, we've been focused on growth and therefore we're calling for 25 basis point cuts, and yeah, the market's put all its weight on there. But I think now things have changed, and why I say that is because I just think it's really impossible to model inflation. You know, the original school of thought was that we were going to get these one or two price shocks. Yeah, the price level was going to go up in line with tariffs, and that was the conventional wisdom. And now it's changed. I think the market is saying, look, we're going to get, go and look at Walmart's CFO said last night. I mean, that methodology has changed to more of a drip feed, a slow grind, and it will be a progressive input into the consumer over time, and it will probably peak out in Q1 of next year. So that's just been really hard to model, and that makes our visibility of pricing inflation just very difficult to do. And I think that is the concern for a lot of the hawks on the Fed board, is that they will be looking at it going, yeah, our visibility to price this accurately is poor, but we know one thing: it's likely to go up above 3%, you know, further and further away from our target. How can we cut rates in an environment where it's doing that? Now, the other factor is these hawks on the Fed board will say, well, like if we do get another weak payrolls number on the 5th of September, well, what happens then if we do see it starting to turn around? You know, Trump, a lot of the factors that have caused the weakness in payrolls are things around immigration, all these factors that Trump can change pretty quickly. And he'll juice up the economy with fiscal, and he'll have to do so as we go into the latter stage of next year, because he'll want to hit the ground running in the early of next year to really pump up the economy going into the midterms next year. So what happens if we cut rates? Inflation keeps pushing higher, and then lo and behold, we don't get a collapse in the labour market, and we actually get a turn in the labour market. Then the Fed's credibility is it's already under pressure now, but it will be absolutely shot to pieces. People want to sell US dollar denominated assets. No one want exposure there. People are already talking about what happens, thinking about 2021 with the whole transitory fiasco kicked in. So there will be a lot of conjecture to go, well, if we cut rates into a rising inflation, but the labour market doesn't continue to deteriorate, that's our credibility toast. And then that would have big ramifications. You know what would happen then? The bond market will take the Fed to town. Yeah, they would smash the long end. It will go up, and they'd just say, the bond vigilantes would just absolutely go to town. That's a massive risk for the Fed. I'm not saying it's going to happen, but it is a risk that they would be very cognizant of. And it would be a possibility why they'd hold off in September. And I think it's probably why the 70% implied at the moment is too high. Now, it all comes down to the data, Blake, of course. It's down to the next payrolls number. It's down to the next CPI print. They hold the magical keys to the castle, and there's going to be so much focus on those ones. Anyway,
and not to mention, we just lost our BLS head, so we got a new one.
Well,
So
that's it. I mean, that's the factor. Is like, when you get the payrolls numbers coming through on the 5th, yeah, we're
do you
pretty.
trust it?
Yeah, if they're weak, Trump comes out straight away and goes, "Yeah, the numbers are fictitious. They're bollocks anyway." And yeah, there you go. And I think the interesting thing, I think one thing's for certain, like make me a market here, Blake. What's your bid offer spread on uh, if Powell comes out with something a bit more nuanced, maybe a modestly hawkish in the market's eyes, Trump coming to Truth Social within 5 minutes and slamming him. What's your market?
Uh, my spread's going to be pretty wide. I don't know if I want to take the bid on
You
that
don't
one.
take you don't take my business.
Yeah.
I'm buying whatever you're putting on the offer, mate. Anyway, let's move on because another factor is that people are watching Nvidia earnings now. Obviously, if you're in trading gold or the US dollar, it's not something that you're going to be heavily focused on. But we do know that that it is the most watched stock in the market. The implied volatility in the market is 5.8% up or down. So given the weighting on the market, what's that equate to on the S&P? 0.5%. All other
Yeah.
stocks having no move. If Nvidia moves 5.8% up or down, that would equate to about a 50 basis point move in the Nasdaq. Sorry, it's S&P. About 80 basis points in the Nasdaq. Obviously, the other AI stocks would go with it and follow an appreciation. So that just increases the weighting, which is why this is for any index traders out there, equity futures traders or anyone trading those single stock names. This is one to watch. Now, obviously, with Nvidia, we know they beat earnings every time. The question is what extent they'll do. They're guiding to revenues on a quarter of 45 billion. The streets actually a bit higher, about 46 billion. I'd imagine the buy side are probably something like 46.5, 47 billion, and that's what they'll need to do in revenues. They'll probably need to guide to around 53 for the next quarter. Obviously, with a company like this, you're looking at gross margins and operating margins, and they're expected to push up to about 72.1, and going forward into Q3, a little bit hotter into 73%. Fantastic margins, but we're expecting those margin expansions. The stock's really been held up at 184. That's the level the bulls want to break. And if we do see on a closing basis, we could take out 200. I think 173 to the downside is your support where the market's been happy to buy. But obviously, there's a lot of things going through. In fact, I've just got a headline breaking news right now saying Nvidia orders suspension to H20 chip production. We'll have to see how that goes through. Sounds like a material headline coming through. But how much are you looking at this earnings report? It's always a victim of its own success, and they have to please a very high bar. But what are you looking for? Is this something that you're going to be focused in the after hours on Wednesday?
I'm going to be focused on the price action in Nvidia. You think about like a 5% move in Nvidia. It only takes us. I mean, we're still in breakout territory. Any which way you slice it, the stock looks bullish, Chris. You can't argue that. The one thing I do worry about, because when you look at whether you're looking at the S&P, the index itself, we have a little false breakout that's developing. So that's obviously a risk to the market as a whole, and what could compound that weakness would be obviously I don't want to say they're going to miss, because they're not. It's more of like, is it all priced in, as you point out? And so if we have a 10% move, then we're talking about testing like the breakout points near 155, 160, and that's where the market gets very, very nervous, I believe. But as you pointed out, it's Nvidia, trying to fade Nvidia and try to anticipate what the reaction is going to be to its earnings. You have to assume there's going to be plenty of buyers on dips, but are we in too frothy of an area? So I'm just more, I'll be watching price action. I don't dig into the earnings as much. I'll just be watching the reaction and knowing that the market's going to have an exaggerated move in the direction that we see Nvidia moving in the after hours.
I think the point here is that this is such a love stock, and you've got the 50-day would probably be the line you want to look at. $166 is that point. That's been a good trend filter. I think buying weakness in dips is the way to go. The market's been very happy to that, but obviously it depends on what they're saying about their product mix, the growth, what they're really saying about H20 here, and obviously other factors such as the 15% revenues they're paying now to the Trump administration for their sales to China. But I mean, there's a quality business, and there will be a level. I think with pullbacks fairly well contained, that everyone's going to start thinking, yeah, this looks good again. But from a momentum perspective, $184 is your line that you want. Well, $184.48 was the exact high. That's the level you want to see break, and then $200 becomes the momentum trade that you want to look at for me.
All right. Speaking of momentum or maybe lack of momentum, I want to go to the last topic here, Chris, and I want to talk a little bit about crypto. You'd pointed out, I believe it was last week or the week before, about Ethereum is breaking higher. Actually reached its previous high, which was also 127% extension. It stalled, but I think the thing that's got my attention now is Bitcoin wasn't following. And more importantly, Bitcoin hit 112,000 yesterday. Ethereum hit 4,062, which 4,080 was the breakout point of its previous high from whatever it was, like a year and a half back. Anyway, those two levels, I call them the line in the sand. And right now, Bitcoin's very sluggish. Yes, we're near all-time highs. Yes, we're still in breakout territory. But if you look at the price action of Bitcoin, recently, it's just been kind of holding on for dear life, and I think we're testing that line in the sand. So my question is, are we at risk at this point with equity markets? We're at the end of summer. We made a slight false breakout, but still near all-time highs. Do you keep buying these dips in crypto, or do you think that crypto's signaling that maybe there's some weakness coming ahead? How are you reading crypto at this point?
Well, it looks weak. I mean, I wouldn't be buying now. I mean, I'm a staunch momentum trader when it comes to crypto. I love it. I think it's one of the best trading vehicles around. I mean, I love the distribution of outcomes. You don't get this in equity markets where you get this slow, steady grind up and then up the escalator, down the elevator sort of thing. Spot up, vol down, and then you get the big collapse, and more aggressive selling to the downside, and volatility goes up, spot up, vol, spot down, vol up, sort of it. And but with crypto, you get this kind of two-way sort of distribution, this more normal distribution where the moves on the upside can be just as big, if not bigger, than the moves on the downside. And I love that sort of more sort of normal distribution playing through. But right now, the way I look at crypto is from a momentum perspective. Momentum's the downside, and if you want to buy for me, I wouldn't be buying the dip. I'd be buying the rip after the dip. Let others do the hard work, put in a base. When the market starts moving up, that's when you jump on. It's like go to the party when the shots are coming out, Blake. You don't just when the DJ's setting up. There's the old metaphor. Well, my metaphor anyway. And that's the way it is. So I think it's a great trading product. But right now, you're 112. I mean, anyone just pull up a daily chart and you can see the significance of the support around there. And if it breaks there, that's negative. 4,100 in Ethereum has been where I've been looking, and we held it really like a boss the other day. But we couldn't get back through the 50% retracement of the recent sell-off. So, and we're rolling over again. If you look at what rallied, what was working when Ethereum was working, and was the junk side of town. The high short interest stocks were working, outperforming. The ARCs of this world were outperforming. The companies with the stocks in the market with poor gearing ratios and various factors we're outperforming. That's all rolled over now. People are trimming that back as we go into September. So it's no surprise now that we are seeing these. I mean, there's obviously other factors that have really helped things like Ethereum, such as better regulation through the Genius Act. And you've seen these emergence of these these Ethereum treasury entities who are amassing and buying it on their balance sheet, and they become big players. And you've seen that along with the ETF flows. But ETF flows have changed. So I think from a pure price action, I wouldn't be buying the dip. As I say, wait for the dip to be bought, and then you wait for the rip above that, and then that's for me the best way. But you're at really big levels in these cryptos, and I think that needs to be respected. I wouldn't be trying to be a hero. I'm never a hero, to be honest. Anyway, so I'm just.
And I'm good with that.
I think I'd actually be looking at this much more from the short side at the moment. It's a seller's market. Rallies are being sold pretty quickly, and I think it breaks these levels. I'll be looking to be shorts in the short term. That's the setup. All right, let's go to dollar Swiss. Look at the beauty of this chart. I mean,
it is so pretty.
Yeah, I think one of my colleagues was messing around with the fibs and changed it into sort of Josephus and his Technicolored Fibonacci pattern. So I like this one. Yeah, it's an interesting one. You've got a very, very cleanly defined floor in the price. Now, obviously, if you're putting stops below those levels, everyone else is as well. But what we can see there is every time we're going down into that into the horizontal support level, the market's been very happy to buy. It's been very happy to sit on the bid. You know, you've got the long wicks through there. Dollar yen's a very similar sort of setup as well. You've got a very clearly defined level around 147.10, around that kind of area where you see market just bids coming into the market every single time, and it's pushed up. Now, we've made 3 consecutive lower highs. And again, yeah, that suggests to me being cautious. It's yeah, Blake's covered his US dollar shorts going into this. I'm not sure if he did that on dollar Swiss, but it's similar to euro dollar. It's the opposite. And now we're looking at a situation now. Yeah, if we were to see another weak payrolls number in 7, I think this pair goes materially low. I think this is one of those great recession hedge over time that you'd have. But for now, it's holding the line like an absolute champion. Um, you know, if I'm going to be long here, it'd be very small size because it's not really anything I'll do in terms of momentum strategies. But yeah, like, I think in terms of a setup, um, yeah, I think this is an interesting one to focus on here.
Yeah, that one's a really interesting one. You know me, I've been playing the Swiss franc to the short side. I love the fact that it's creating this base, Chris. So really, really nice setup. Really nice one.
Thanks, mate.
Um, you're welcome. My first setup is going to be the euro sterling, and this one is a very interesting. I think Okay, so first and foremost, I've been hanging around my colleagues. My colleague Ryan Littlestone, and then your colleague Michael Brown. I think hanging out with these guys in the UK from the UK too much. I'm like this like ultimate. I feel like always bearish sterling, and
Well,
and even you see it's dirty.
the
So
problem for
I
me is that hanging out with Michael Brown for 2 weeks over in the UK cost me a lot of money, to be honest. I mean, I think the guy owes me about 15 coffees now. So, hanging out, you get good perception. You do become a sterling bear,
you do.
but you also cost you a lot of money as well.
Yeah, well,
Love
okay.
life.
So that gives us this that gives us this really unique setup. We got this head and shoulder pattern, and you can see clearly the 38% retracement is at 86 pence. And just for the record, I'm actually long euro sterling right now. So, but clearly, if you get below that neckline or below 86 pence, it is bearish. But the bullish setup is if you break above the right shoulder, so basically 86.70s 86.75, it's off to the races. And then that horizontal resistance that you can't really see there, that's capped us since I'm gonna have to go back to 2023. So if we started breaking that purple line above those highs, you're talking about trading in levels that we haven't seen since early 2023. So I think it's a setup for either direction. I'm happen to be bullish right now because I'm bearish sterling because I hang out with Michael Brown and Ryan Littlestone way too much. But at the same time, I can't ignore the head and shoulder reversal setup that's
Yeah.
there as well.
Well, the pound's been an absolute superstar because they've had a lot of the rates cuts. Pricing has come out. You know, you're looking at a central bank now where the market's implying the next rate cut it's not till March of next year. We saw a slightly hotter inflation number the other day, but the question now is: has all that rate cuts come out the price? You know, growth's still pretty lackluster, and we start talking about stagflation, which is a bind for the central bank. So I think maybe the rate cut pricing has come out the market. Yeah, we've come to a much better position for sterling shorts to apply. I mean, it's probably if you've been fading that move all the way up in the pound, it's hurt, especially on leverage. But maybe now we've got to that point where the rate cut pricing's come out and it's time to fade it as per your chart there. So
All
you
right,
should
fair
see,
enough.
yeah, I do get that point. And yeah, well, we'll see the setup. That's a good reversal pattern there. So one to watch. Let's bring up the old yellow pebble gold because it is boring, real boring. And boring can be good, like, I mean, you've got this really strong, predictable trade. I mean, and it's just been into 34.50, 34.30, 50. That's your range. You just fade it into the top end, sell it into that point. I mean, we've only had 4 occurrences of that. So it's not like, you've got this real high probability, but there is a really clear defined ceiling on the market. On the downside, really, since June, you're basically going into 32.50. And again, right now it's mid-range. It just looks so comfortable where it is at the moment. It's just in just a beautiful balance. It's in fair value, and that reflected in the flows. You've seen clients are doing much more two-way business, long and short. The ETF flows in the GLD and also in the Chinese ETFs are pretty lackluster. Not really much going on, and I think the investment case for gold is hard to see a strong one in the short term. And what I mean by that is that, a lot of the geopolitical risks have subsided. There's nothing there that really wants to make you want to hedge yourself against anything. Not that the market's really going to move on. And then obviously for me, it's like, what happens on the rate story? Well, we're still waiting to see that out. But a move is coming. I think a move is coming. A quiet market doesn't stay quiet for too long. But the question is which way does it go? Do we get a bear flattening of the yield curve driven by rate cuts coming out as payrolls perhaps not so bad, but inflation risks manifest? In which case, despite big gold being this inflation hedge everyone talks about, I don't buy that. I think in this situation, gold would go downtown, test the bottom end of the range, and I think it would bear trend. Where the bulls want to see, though, would be anything that just really has the market saying you guys have made a policy mistake. Fed credibility is absolutely shot to pieces. They get that in hindsight. People start thinking about economic deterioration. They just want to shy away from US dollar denominated assets. Purchasing power of the dollar falls, and I think that's it. So Fed credibility getting really called into question. It is at the moment, but properly called into question, and people putting money to work in that trade. Dollar breaks out new highs and off it goes. But that's something for the future. But I can tell you what I think the investment case is going to be. Which way it goes is yet to be seen. But I think we've got a very fair valued market at the moment. I think it will change as we go through September, and I think we'll see a trend that people can latch onto.
Well, the lines, the levels are clearly defined on your chart, Chris. Clearly defined. All right. So my last setup is going to be Bitcoin. And I know I talked about crypto a little bit earlier. So you guys already know that line in the sand. And the reason why it's such an important level, obviously, was the breakout that took us to new highs. And took us to new highs once we broke out in July. The problem is, as Chris pointed out, there are sellers on rallies, and look at the fib level that we're testing. It's only the 24% retracement. Now, if you think about it from a trend point of view, this is obviously clearly in an uptrend, but uptrends don't mean that we're going to go up every single week or every single month. And if we break below that 112,000 level, I think it opens the door for 104,000, and then you start looking at the 100,000, big figure level. But even if we drop to 104, 105,000, that is a 38% retracement. It might be a 5% drop, but it's also still in the realm of making higher highs, higher lows in a shallow retracement type of situation. You start getting below 105,000, like 104,000, you start getting below there, then I think the uptrend becomes a little bit less clear, and then you have to start worrying about a little bit deeper of a pullback towards, once you get towards that 200 DMA. But 112,000, that's the line in the sand. That's the level it should be watched, and I think we're either going to make it or break it tomorrow. If you're looking at risk assets, maybe instead of trying to stare at the S&P and figure out what the S&P is going to do, just keep a real close eye on what Bitcoin's doing around this 112,000 level.
Good stuff, my man. All right, let's go to play of the day. Play of the day. Well, long China, short the US. It hurts, doesn't it, Blake? All right, so what you've got here is, again, it's just the pairs trade that I love. So yeah, China is the numerator here. So you can see that after a period of underperformance, it's now that ratio is going up. It shows that the Chinese equity markets, in this case, I've used the CN50 relative to the S&P 500. Russell would probably be a better trade there, but you'd have to look at the ratio. But yeah, the CN50 effectively, for those looking at it, is a Pepperstone product. It's based on the A50. And really what you're looking at is the top 50 mainland companies that are packaged as a futures market on the Singapore exchange. It's priced in US dollars. So basically you've got a dollar for dollar pair. There's no currency effect in this. But you can see now that the Chinese equities, mainland equity markets are outperforming. Now, that's not necessarily a reflection of economics. It's a reflection of liquidity. It's a reflection insurance companies are buying. It's a reflection of the excess liquidity that we're seeing in China. We're talking about aggregate finance. We're actually talking about system liquidity that's been pushing up. and that's really been boosting the market there. We've obviously seen China talking about doing more on the retails and boosting consumer, and again, that's been factored. But also, let's have a look at the AI plays in China. They've been working beautifully as well. That's been boosting. Now, if we do see next week some disappointment in Nvidia, let's say it goes through that 50-day, let's say it comes down, where's the money going to go? It's going to flow into Chinese AI. That's been the switch. People have been switching out of a very, very hot US internet, AI space, tech space, semis more broadly, and back into China. And whether that's still got more juice is something that obviously we need to make the assumption of. But as we go into this world where, yeah, if we do see a Fed credibility being called into question, it already is, but much more so that people want to take action. If we were to see a flatter yield curve driven by rate cuts coming out, the dollar rallies, not great for China, not great for Hong Kong. But if we were to see US sats under pressure, I think this continues to outperform. So I like being long China and short the US in this situation. It's a tactical trade. It's working already. I think this goes further. I think it's got much juice here. I mean, it's just being long. I mean, go and have a look just bring up a daily chart, the CN50. You can see it's at the highest level since 2015, and it hasn't been a parabolic impulsive move up. It's been this beautiful grind up. So it's not like it's just overloved and overbought.
That's a nice looking chart. That's a beautiful looking chart, Chris.
Beautiful thing.
So, and you know what? My play of the day is something that I'm not long right now, but it's going to dollar mex, and it looks like almost the chart like you just pointed out, but just before the move happened, and that's what I'm looking for in the dollar mex. I call it Taco Tuesday because, well, frankly, it was my son's 21st birthday on Tuesday,
That's
and
amazing.
we did go to a place. Thank you. We did go to a place where we could get tacos. So he's officially a man. But you know what? We also like to name some of our currencies, and the Mexican pesos fondly named the taco. So whether it's Taco Tuesday, whether it's Taco Friday tomorrow, or maybe it's even Taco Monday, come early next week, I'm actually looking for a break above 18.87. And if we break that trend line, that's a trend line that's been there since May. And then that's where I think this base has been building. And I'm looking for it to reverse. Chris, back before this new year, and we were talking about Trump winning the election. You and I have discussed on many occasions back in November and December of 2024 that the US dollar Mexican peso would trade down to an 18 handle. Look, we're at 18.7 or 18.80 right now, 18.75. We've been basing down here for the last couple of months. It looks like we're about ready to get our Taco Tuesday on. So there it is.
Quick question.
Yeah.
We don't want to explore family too much in this show, but does your lad get in front of the charts? Does he like to follow in his footsteps of his old man in terms of the trading?
Not my oldest. My youngest does, but he actually we just dropped him off at university over the weekend in middle America, if you will. So he's off in university, and he's my chart reader. But my oldest is my drinking buddy.
Oh, mate, I'll tell you what, it's an emotional time in the old Morrow household at the moment. You've got one going off to university, one having a 21st birthday. Jesus, you must be an emotional wreck.
It is. My wife is quite the train wreck right now.
If I was there right now, I'd give you a hug, buddy, but I'm not.
Thanks, buddy. I could use one.
Yeah. Anyway, thanks, mate. I appreciate all this, giving up the time for to part your wisdom in such a defined period in your life. But yeah, it's obviously very greatly appreciated. And for everyone home, thank you for joining us, and we'll see you back next week for more of The Trade-Off.